Yes, students. Now we will learn what are the tax rates applicable on special income. Till now, whatever we have discussed is the tax rates applicable on normal income, which will vary from person to person or from scheme to scheme. Guys, before I start itself, again I am clarifying. Whatever tax rates is applicable on special income is same for every category of associate. Whoever is having these incomes, for them the tax rate is same. Sir, what about the schemes? Even in case of different schemes, the tax rate remains same. I might be following default scheme, I might be following optional scheme. Will the tax rates on special income change? No, it will not change. So what are those we will see, guys? Income taxable at special rates, special income. It is called as special income. Whatever tax rate is applicable on special income is called special rate. For certain special income like long-term capital gains, lottery income, specified short-term capital gains, above slab or normal rates are not applicable. Above means whatever we have discussed till now, that rates are not applicable. These incomes are taxable at special rates for all categories of associate, irrespective of the scheme followed by them. So special rate would remain same for all associate under all the schemes. While slab rate or normal rates are given in annual finance act, whereas special rates are given where? In income tax itself. And for each special income, there is a dedicated section where they are telling what is that special income, what is the rate applicable. Sir, are we supposed to know the section number also? Yes, guys. Each of this, very few is there. You know what is the section number, what special income it covers, and what is that special rate. Rate in the sense, the tax rate. Yes. In respect of special income, as mentioned below, Income Tax Act 1961 has prescribed the special rates or specific rates. The special rates of tax have to be applied on the respective component of total income, irrespective of tax regime and category of assessee. Guys, please be careful. First check whether total income includes special income. Don't apply the special rate on entire total income. No. First check whether total income includes any special income. If yes, apply special rate on special income. Then for that, you need to add tax on normal income. I already explained you the procedure. I will just show you once again. Just a minute. Yeah, this is what the procedure or format we need to follow. First, we will check whether we will always calculate tax on which figure? Total income. First, check whether total income has any special income. How will I know? You will know. Now, once we study this, you will know what are special incomes. They would have mentioned in the question whether the assessee has any special incomes. If yes, apply special rate on special income and calculate. Then the remaining would be the normal income or balance income or other income taxable at slab rates or flat rate, which is nothing but normal rate. If I add up both, we will get gross tax. Sir, what if by chance if question is silent? They have asked us to calculate tax liability. They have given total income, but the question is silent about special income. Assume entire total income as normal income. And assume that entire total income is normal income. This is only when question is silent. Okay. Now coming back to special rates. One by one, important guys, you are supposed to remember it. Yes. First, guys, there are three capital gains special income. Let us discuss that first. Three capital gains special income. These three income are covered in 111A, 112, and 112A. Where is this income taxable is under the head capital gains, but they are special in nature. That means special rate is applicable. Special rate is applicable. So what is it, sir? First one, Section 111A covers short-term capital gains on the transfer of only three assets. Which are those three assets, sir? Listed equity shares in a company, units of equity-oriented fund, or units of business trust. In short, I call them as left. What? Left. In short. This is only for remembrance purpose. Left stands for what, sir? Left, left. Left. LE stands for listed equity shares. F stands for units of equity oriented fund. F for fund. Then T stands for trust. That is unit of business trust. This is only for remembering it, guys. Okay. Sir, what is that unit of equity oriented fund or unit of business trust and all? I will be covering it in capital gains head, guys. We will cover this again in capital gains head. But now we'll focus more on tax rates only. Okay, yes, sir. What is the tax rate, sir? 20%. Assume you have a short-term capital gain on the transfer of listed equity shares, 2 lakh. What is the rate applicable? 20%. 2 lakh into 20%, 40,000. Oh, but there are some conditions. What is it? Conditions for availing the benefit of this concessional rate are the transaction of sale of such equity share or unit should be entered into on or after 1st October 2004, which is long back. Sir, why have they given this? Guys, this is the date on which something called as securities transaction tax was introduced. STT. That is, whenever you buy and sell the securities, you are supposed to pay STT. Okay, that means this condition is telling you should have paid STT. You should have paid STT. STT stands for Securities Transaction Tax. Sir, is it a part of income tax? No, no. It is separate thing. That is as per SEBI. Okay, but to claim the benefit of this 20% or for the 20% tax to be applied, condition is you should have paid Securities Transaction Tax. Such transaction should be chargeable to Securities Transaction Tax. Sir, why they are given that date before? Because before that date, STT was not there. STT was introduced from 1st October 2004, guys. Anyway, that date is not relevant. Why, sir? Because when will transfer happen to you guys? In your exam, transfer will definitely happen during previous year, 25-26. That means STT is applicable, huh? Yes, it is applicable. Next, sir, what if there is any other short-term capital gain? For example, there is a short-term capital gain on the transfer of land, building, jewelry, or any other asset other than left. Then it is a normal income taxable at normal rate, which we already discussed. Only 3 short-term capital gain is special tax. What are those? Transfer on LEFT. Got it? Yes, sir. So I have given a note, you can see there. All other short-term capital gains are taxable at normal rate applicable for the assessee as per the scheme, as per the category of person, which we already discussed. Only 3 short-term capital gains are special people. Next, coming to long term. Sir, before I go to the tax rates, sir, what is this short-term, long-term? Guys, see, when we sell the capital asset, we are supposed to compute capital gain. We are supposed to compute capital gain. So, whenever there is a transfer of capital asset, we need to check whether the capital asset is a long-term or short-term capital asset. Short-term capital asset or long-term capital asset. Sir, how will I know that, sir? It depends on the period of holding. Sir, what is period of holding, sir? How long did you hold the asset before you sell it? Means from the date of purchase till the date of transfer. How long did you hold it? Here, there are few assets. If you have held it for more than 12 months, it is long term. There are few more assets. If you have held it for more than 24 months, that is 2 years before transfer, it is long term. If it is less than that, short term. Sir, which asset 12 months, which asset 24 months? I will cover it in capital gains bit, guys. You need not worry. How to classify it? Yes. So, if there is a transfer of short-term capital asset, we need to compute what, guys? We need to compute short-term capital gain. If there is a transfer of long-term capital asset, what should we compute? Long-term capital gain. Sir, is it important? Yes, you need to classify it. If there is short-term capital gain on the transfer of LEFT, which we just now covered under section 111A. What is the tax rate? 20%. Sir, what if it is other capital asset? What if it is other capital asset? Taxable at normal rate. It is a normal income taxable at normal rate. Okay, sir. Then what if it is long-term capital gain? If there is long-term capital gain on the transfer of LEFT, that is listed equity shares, units of equity oriented fund, unit of business trust, then the tax rate is given under section 112A. What is the tax rate, sir? 12.5%, but only in excess of 1.25 lakh. What is it? I will explain later. Sir, what about any other capital asset? Other capital asset. Then it is covered under section 112. What is the tax rate, sir? 12.5%, guys. 12.5% on the entire amount. On the entire amount. Please pay attention. Please pay attention. Long-term capital gain will always be special, irrespective of which is the asset transfer. It will always be special. Whereas short-term capital gain will be special only if it is on the transfer of LEFT. If it is any other asset, then normal income taxable at normal rate as applicable to the assessee under the respective scheme. Hope you guys got it. Yes, sir. Let us go back. Until 11A we have done. Same thing, same asset. If it is long term, what? Guys, I repeat, whenever there is a transfer of capital asset, we need to classify whether it is short term or long term. How will we classify it, sir? Based on period of holding. What is period of holding? The time gap between date of purchase till the date of transfer. If the asset is held for more than 12 months or 24 months, depending upon the type of asset, we call it as long-term asset. When there is a transfer of long-term asset, we need to compute long-term capital gain, for which the rates are different, depending upon the type of asset. Anytime, long-term is always special. Then coming to short-term, if the asset is held for less than 12 months or less than 24 months, depending upon the type of asset, we call it as short-term asset. When there is a transfer of short-term asset, we need to compute short-term gain. And every short-term gain is not special. Only three. Only three. Oh, let us continue. 111A we have done with. Next, we will move to 112A, guys. Because they both are connected. Because they both are connected. Yes, sir. What is it we will see? Section 112A covers what? Long-term capital gain on the transfer of same left. What to? Same left. Same asset, but nature is long-term. Nature is long-term. Which are those, sir? Listed equity shares in a company, units of equity-oriented fund, units of business trust. Sir, what if it's unlisted shares? Not covered here. They are clearly telling now listed. If it is unlisted, obviously not covered. Okay. Next, what is the tax rate, guys? 12.5% on the gain exceeding 1,25,000. On the gain exceeding 1,25,000. Sir, I didn't get this point. Please listen. Please listen. Interesting. Assume I have a long-term capital gain on the transfer of listed equity shares. 1 lakh. 1 lakh, I have to include it in my total income calculation. But while calculating tax, it will be 0. It would be 0 because it is within 125. Next, assume I have a long-term capital gain on the transfer of units of equity-oriented fund. 2 lakh. First, I should include 2 lakh in my total income calculation. Under which head? Capital gains. But while calculating tax, it is 2 lakh minus 1 lakh 25. That is remaining 75 into 12.5%. Into 12.5%. Assume I have a long-term capital gain on the transfer of unit of business trust. 10 lakh. So entire 10 lakh has to be included in my total income calculation under the head capital gains. But while calculating tax, 10 lakh minus 1 lakh 25 into 12.5%. Is that clear? And please be careful, 1,25,000 is per year amount fixed. Sir, I have long-term capital gain on the transfer of all these three. Okay, now all these three. How much, sir? Assume 2 lakh each. How much is my capital gains income? 6 lakh. Include it under the head capital gains first. While calculating tax, it is 6 lakh minus only 1 lakh 25. Don't do 1 lakh 25 into 3. 1 lakh 25 is maximum per year. Hope you guys got it. Now you might also ask me, sir, what if my gain itself is only 50, less than 125? First, include entire 50,000 under the head capital gains while computing total income. But while calculating tax, it would be 0. It would be 0. Not your entire tax would be 0. Tax on 112A income is 0. You might have other incomes. You need to calculate tax on that. Hope you guys are getting it. Guys, simple logic. Listen. Here this 125 is not the exemption in income. It is the exemption given at the time of calculating tax. Why I am repeating this is because students, what they will do is, assume I have 2 lakh long-term capital gain on the transfer of LEFT. While calculating income itself, they will reduce 125. No, that is mistake. Blunder. What you should do is whatever is the entire long-term capital gain, include it in your total income calculation under the head capital gains. While calculating tax, reduce 120. Reduce 125. Clear? Yes. We will solve some illustrations later where I will take care of all this with respect to how to apply it. First, let us understand the provisions. Got it? Yes, sir. So, here also condition is you should have paid STT, guys. You should have paid STT. So, what is that condition? We will see. Condition for availing the benefit of this concessional rate is securities transaction tax should have been paid. If it is equity share, both at the time of purchase as well as sale, you should have paid STT. And unit of equity oriented fund or unit of business trust means at the time of sale, you should have paid it. Okay, in simple, let me tell what is this unit of equity oriented fund and business trust. Guys, you know mutual funds, no? They will have various schemes. Now you are investing in a mutual fund scheme. Whatever you are investing, they will invest that money into equity shares. Whatever, I think we are putting 10,000 every month. That money is in return invested by them where? In the equity shares of the company. In that case, we call it as you are investing in which fund? Equity oriented fund. There is some criteria and all, minimum so much should be invested in equity shares, which I will explain in detail in capital gains chapter. Then what is this unit of business trust, sir? Guys, see, I want to invest in real estate, but I don't have so much money to invest crores together, lakhs together. Now, there will be some unit of business trust where if I invest my money in business trust, in return, they will invest in real estate. Means I will not be the complete owner. I will be the unit holder. Part owner. Correct. Assume I have purchased 10 units. Whatever is the value of the 10 units, only that much I will own, not the complete building or not the complete asset. Here, this is like partial investment. Same like equity shares also. Correct. If you buy some equity shares, you are called owner. Are you a complete owner? No, partial. Correct. You can vote, you can participate, everything is there. But you may not be able to make decisions because you might not be having majorities. Is that clear? Yes. It will be considered, but you will not be the sole person to make decision until and unless you have a majority holding. Okay, done with this. So both we have covered guys. Short term, long term. Correct? I repeat. If there is short term capital gain on the transfer of left, where is it covered? 111A. What is the tax rate? 20% on the entire amount. Entire amount. Whereas if there is long term capital gain on the transfer of left, then where is it covered? 112A. What is the tax rate? 12.5% on the amount exceeding 1,25,000. So 125 benefit is only for 112A, not for 111A. 111A full amount is taxable. Full amount, whatever is the gain. Oh, fine. Then what about any other long-term gain is covered under 112? Any other long-term gain is covered under section 112. So long-term capital gain on the transfer of other than covered under 112A means other than left. Other than left. Other than left means what, sir? Land, building, jewelry, or any other thing. But other than left. Other than left. Okay. What is the tax rate? Is actually 12.5% without indexation. For long-term asset and all, there is something called as indexation. What is it? In simple, I will tell. Well, I would have purchased some asset 10 years, 15 years, 20 years back for 1 lakh, 2 lakh. Today it is worth crores together. Now, if I just allow you to claim only expenditure, it is not fair for you. Correct? Because, sir, over a period of time, there will be inflation because of which cost would have gone up. So I should give a benefit of inflation to you. Okay, so that is only available for long-term asset. But last year, madam, take away that also. She took back that also except for 2 assets. Okay. So indexation means I would have purchased the asset long back at a lower cost. When I am selling now, pay attention, sir. When I am selling now, I can claim the benefit of indexation, which is nothing but cost inflation index. Clear? What is it and all, guys? I would be covering in detail because all this are more of calculation part. I will be explaining it in capital gains head. But one example I will give it after this. There is a long-term capital gain on the transfer of land or building or both. Land or building, which we call it as like real estate asset. Acquired by whom? Resident individual. or HUF. When did they acquire? Before 23rd July. Why they have mentioned 23rd July is in capital gains head, the major changes happened on 23rd July, which is last year. 23rd July 2024. Okay. So I am a resident individual. I had purchased a land or building before 23rd July 2024. Assume in 2015 I had purchased. But when am I selling it? In previous year. Only when I am selling in previous year, we need to compute capital gain. Agree. So in that case, I have a option tax. I can either pay tax 20% on the gain with indexation or 12.5% on the gain without indexation. Obviously, I will not pay both, whichever is low. It is an option given to resident individual or HUF. Resident individual or HUF. Okay. In any other case, no option. You have to pay 12.5% tax on the gain without indexation. Without indexation. I repeat. I am a resident individual or HUF who had purchased land or building long back. I am selling it in my previous year. Then I have to compute two gains. One long-term capital gain without indexation, another long-term capital gain with indexation, and apply the respective rates. And should I pay both? No, whichever is lower. Whichever is lower. I will explain with an example. Listen. All this we will discuss in detail later, but just to make you understand this tax rates, I am taking this example. Assume guys, I am a resident individual who had purchased land. Let us take it as land on 10th August 2015. So this is before 23rd July 2024. Purchase date? Yes, sir. Who am I? Resident individual. Okay. Cost of purchase is how much? 10 lakh. When am I selling it? 10th November 2025. That is during our previous year. 25, 26. Correct? Oh. 25, 26. That is our previous year. Should we compute capital gains? Yes. Now, I need to compute two capital gains. One is with indexation, the other one is without indexation. Chalo. So, sale value, let us take it as 50 lakh. So, what would be the long-term capital gain without indexation? Without indexation means you need to just reduce cost. That's all. 50 lakh minus 10 lakh. How much it comes to? 40 lakh. So, on the gain without indexation, what is the tax rate? 12.5%. Calculate. 40 lakh into 12.5% comes to 5 lakh. Keep it aside. I am naming it as A. 1 part done. Then again calculate long-term capital gain with indexation. With indexation means what, sir? I need to apply indexation for this cost. So 10 lakh, the cost you can see. We call this as index cost of acquisition. That's index cost of acquisition. So 10 lakh into 376 divided by 254 I am doing. Sir, what is this? Guys, this is called cost inflation index. Cost inflation index. So I should take actual cost, multiply that with cost inflation index for year of transfer. Which is the year of transfer? 25-26. What is the cost inflation index for it? 376, which is notified by government. Then I need to divide it by cost inflation index for the year of purchase, which is 1516. 1516. So if I do this, I will get index cost of acquisition, which will definitely be more than 10 lakh. Which will definitely be more than 10 lakh. Okay, sir. Now, what is my long-term capital gain? With indexation, we are getting 35 lakh 19,685. On this, what is the tax rate? 20%. Means madam is giving in one hand and taking in another hand. Why, sir? Because here they are giving me indexation, but tax rate is higher. This was actually the old rate which was there. Last year they changed it to 12.5% and removed indexation. But lot of people started blasting the government or criticizing the government, telling, I had purchased land, building and all long time ago. Now if I sell, you are telling no indexation. This is not fair enough. That is where they brought back indexation again, but only for land and buildings sold by resident individual. That too if you have purchased it before 23rd July 2024. Got it? Yes, sir. Sure. So you will compute long-term capital gain with indexation. With indexation. On that, what is the tax rate? 20%, which comes to 7,03,937. Sir, should I pay both? No. whichever is lower. Whichever is lower, which is 5 lakh in my case. Which is 5 lakh. Sir, will always this only less? Need not be. It will change case to case. I have just given one example here. Clear. And don't worry much about this part, guys. I will explain about this in detail in capital gains rate because this is something called as fast inflation index. In short, we call it as CII. Hope you guys got it. This calculation you will do only for the long-term capital gain on the transfer of what? Land or building by whom? Resident individual purchased when? Before 23rd July 2024. So please be careful with the date, type of assessee and all. Got it? Yes. Sir, what about any other asset? Or else land building sold by resident individual. But when did they purchase it? After 23rd July 2020. Clear. Not relevant for us because if they have purchased it after 23rd July 2024, then for us it will not become long term. It will not become long term. For us in the sense, for previous year 25-26, it will not be a long term, but still you should know the rate. Guys, listen. If there is long term capital gain on the transfer of land or building which is purchased after 23rd July 2024 or on the transfer of any other asset purchased any time, what is the tax rate? 12.5% on the gain without indexation. Without indexation. So indexation is only in this case which I told you. Oh, let us go back. Okay, I will repeat. No problem. What is covered? Land or building or both acquired by whom? Resident individual or HF when? Before 23rd July. When are they selling it? Obviously in our previous year on any date. What is the tax rate? There are two tax rates. That means we need to calculate two gain. What are those? Long-term gain without indexation. On that, what is the tax rate? 12.5%. Then compute one more gain. Long-term capital gain with indexation. On that, what is the tax rate? 20%. Compare both and pay whichever is lower. Next, land or building or both acquired by resident individual or HF on or after 23rd July 2024 or any other asset acquired anytime. In year, any other asset means what? Other than left and other than land and building. Any other asset. Obviously, left is covered here. Land and building we have covered here. Anything other than will come here. Their date of purchase doesn't matter. The rate is always 12.5% without indexation. So this choice is only in this case, guys. Please be careful. Whereas in any other case, it is 12.5% without indexation. Hope you guys got it. Clear? Yes, sir. Next, this is just a clarification which I have mentioned. In case of non-residents, long-term capital gain on the transfer of unlisted securities or shares of a closely held company. Shares of closely held company means private limited company. Would be taxable at what rate? 12.5% without indexation or foreign currency fluctuation. Even foreign currency fluctuation benefit will not be given. Sir, when I purchased, exchange rate was so much. When I am selling, exchange rate is this much. Can I claim any benefit? No. Clear? In simple, even this will fall in this category only. That's all. That is any other. And it is unlisted. Please be careful. If it is listed, it will fall here. Sold by anyone, resident, non-resident, doesn't matter. It will always fall here. Hope you guys got it. Clear? Yes. Sure. Now, yeah, we'll just now go through this chart. Okay, it is a part of revision material, but I will just show you where I have drawn a chart to simplify the tax rates on capital gains income. Guys, whenever there is a transfer of capital asset, first we need to check whether the asset is short-term asset or long-term asset. So when it will be a short-term asset is if the period of holding is less than or equal to 12 months or 24 months before transfer. If it is held for more than 12 months or 24 months, we call it as period of holding. For few asset it is 12 months, for few asset it is 24 months. Which is it? We will learn in capital gains stage. Next, if there is transfer of short-term capital asset, what should we compute? Short-term capital gains. If it is the short-term capital gain on the transfer of LEFT, it is LEFT. Then it is taxable at 20% now on the entire income. On the entire income, what is the tax rate? 20%. 15 will not come. Okay, sir. If it is short-term capital gain on the transfer of any other asset, then it is taxable at normal rate. Then coming to, if there is a transfer of long-term capital gains on LEFT, then what is the tax rate applicable? 12.5% on the amount in excess of 1.25 lakh. 10% is not there for you. Don't. Then, if there is long-term capital gain on the transfer of any other asset, under section 112, it is special. What is the tax rate, sir? 20% or 12.5%, depending upon who is the assessee and all. Clear? Yes, sir. Guys, please be careful. Every capital gains income is not special. Long-term capital gain is always special. But if it is short-term capital gain, only on the transfer of LEFT is special. Any other is not a special. It is normal. Hope you guys got it. Yes, sir. Sure. So we have covered capital gain special incomes. We have some more special income. We have some more special income. What are those? Yeah, silence. Section 115 BB, silence. 115 BB, casual income. We call it in short casual income. What is it? Winnings from lotteries, crossword puzzles, races including horse race, card games and other games of any sort. Gambling or betting of any form or nature other than winning from online games. What is the tax rate? 30%. Another 5 minutes, guys, pay attention. Sir, here they told other than winnings from online games. Why? Because for winnings from online games, they have added a separate section. 115 BBJ. So net winnings from online games. What is the tax rate? Same 30%, but they have made it as a separate section. Clear. Nowadays, this is more relevant. No, that is why they have brought a separate provisions for this. Clear? Yes. Pay attention. Both of this, if at all, if the assessee has, where it is taxable, sir? Income from other sources. The first three, what we saw, 111A, 112, and 112A. Where is it taxable? Capital gains. Whereas this two is taxable under IFOS. Then the last one, which we already learned, 115 BBE. What is it? Undisclosed income. Assessee has earned some income in the past which he has not disclosed. But in the previous year, the department has detected it, for which assessee is not able to give explanation or whatever he is giving is not satisfactory for the assessing officer. In that case, will it be considered as deemed income? Yes. What is the tax rate applicable? 60%. Tax rate is 60%. But okay, let me just read it once. Unexplained money, investment, expenditure, etc. deemed as income under section 68 or 69 or 69A or 69B or 69C or 69D, which we already covered in first chapter, guys, along with previous year. Okay, sir. So, what is the tax rate, sir? 60%. I have given a note here. What is it? Guys, 60% is tax rate, but surcharge will always be applicable at 25%. No matter how much is your undisclosed income, surcharge is applicable at 25%. Plus 4% cess. Effectively, tax rate comes to how much? 78%. Please be careful, 25% surcharge is on 60%, not on income. I have already explained you the math behind this. Clear? And 4% cess is on what? 60 plus surcharge on that. Clear? Yes, that means surcharge is not on income, it is on gross tax. Whereas health and education cess is on gross tax plus surcharge. One more important thing. Against this unexplained income, you cannot claim any expenditure. You cannot claim any deductions. You cannot set off any loss. Means whatever is your undisclosed income, straight away pay tax 78% on that. That is 60% plus surcharge plus cess. You cannot claim anything against it. Anything against it. Hope you guys got it. Yeah, and more about casual income as well as long-term capital gains. This is not the end. I will talk about it more in the respective head, guys. Yeah, I repeat that point once again. Listen, guys, these three, whatever we have seen, 111A, 112, and 112A. These incomes are taxable under which head? Capital gains. We will again learn this when we go to capital gains head, but little more detail. Then 115 BB, BBJ as well as BBE, whatever is there, these are taxable under the other sources. Even this, if at all if it is there, may not be there always. If at all if it is there, you will tax it or you will consider that under which head? Other sources. Other sources. Actually, even against casual income, you cannot claim any expenditure, you cannot set up any loss and all, but those things I will take care in the respective head, guys. Got it? Yes. Fine. So this is all about the tax rates on special income. If you want, you guys can make a note of this part. This one. This is an illustration on the tax rates on long-term capital gain under section 112 for resident, individual or HUF when the land or building was purchased before 23rd July 2024 but sold during the previous year, guys. That's all about the special rates.